Hey guys, so in this video, we're gonna talk about the difference between stocks and bonds. These are for people who want to know whether what's a better investment that will fit you. Is it stocks or is it bonds? So if you want to know more, check this video out. Hi everyone, this is Marvin Germo. If you're new to this channel, please subscribe and smash that bell so you get updated every time I create new content about the stock market, about the bond market, about investments in general, because I just have one goal. I want you guys to be financially free. I want you guys to take advantage of one of the greatest times to invest. So enjoy the rest of the video. So hey guys, so I'm still here in Seoul in South Korea. We just did our secret garden tour, but I'm trying to take this moment, this opportunity to share more about the markets in general. As promised, wherever I am, whatever is happening, I'll do my best to keep on pumping and giving you content as possible. Now, I know there's a lot of new subscribers in this channel, and there's quite a few who are investing in stocks and quite a few who have not even started yet. And one of the biggest questions that I'd get is basically this: what's the difference between stocks and bonds, and what's the advantages of it? So for those who've been investing in the stock market, here's what it is basically. Please remember this: companies need money to expand. Companies need money to grow. Companies need money to be able to fulfill whatever operations they have. So think about Pure Gold. Pure Gold has debt. Pure Gold also has, they need to build more supermarkets. Pure Gold needs to somehow pay for other operational expenses. And the way for them, and here, the biggest advantage of companies that they're big is people trust them. And not just because people trust them, they have the ability to generate cash easily. So what does that mean? Pure Gold has two ways for them to be able to raise money. Number one is they can borrow money from people, they can borrow money from institutions, or they can allow people to be part owners of the company. So what does that mean? For those who have been following my videos for quite some time, you do know that one of the ways for Pure Gold to raise the cash is they sell their shares, and when they sell their shares, whoever buys their shares becomes a part owner of their company. And that's what we've been talking about when we've been talking about the stock market. When you buy shares of Pure Gold, you essentially become a part owner of Pure Gold. You essentially become a shareholder. So whatever Lucio Ko and family would do to Pure Gold, you're pretty much part of it. You're pretty much part of whatever underlying story that happens there. Now, here's the thing. For them naman to generate cash with not giving a piece of the company, because please remember this, not every owner, not all owners want to give a piece of their company as well. Not all of them want to raise cash by giving a piece of the business, because if you give a piece of the business, that actually means that you're giving them not naman control. As long as, please remember this, as long as you don't give more than 50% of the ownership, you still control the business. However, not all of them want to have other people be part of the company as well. So one way for them to be able to raise cash without giving a piece of the business away, without giving a piece of equity away, is the bond market. Meaning, bonds essentially is just debt. Bonds are essentially, they are borrowing money from institutions, investors. As they borrow money, like any other debt instrument, they get to pay a fixed interest rate. Now, this is what they like. Why? Think about this. If I'm Pure Gold or if I'm Ayala, what the money that I would have when I start, for example, Ayala Land, they build a condo, they buy a property, they only pay, say, 6%, 5%, 4% na bonds. What does that mean? If they pay only 4% bonds, guess what? If they build a condo, they spend, say, 5 billion, 10 billion to start build a particular property, for sure they will earn more than 4%. For sure they will earn more than 5%. So what does that do? The ability of companies to raise money for and pay a very, very small amount of interest is something that they like, since they just need a very, very small amount of interest to pay, and they have a very, very large margin. Think about the largest of the margins. When they build condos, one unit, probably they have 50 to 60% markup per unit per condo. So if the condo is, say, 5 million pesos, 7 million pesos, 10 million pesos, half of that, that's their markup. Half of that is the earnings that they will get from it, and they only pay you 4 or 5% interest as well. So companies like bonds because they only pay a fixed amount of interest, And as they pay a fixed amount of interest, they get to use that cash for a stretched period of time, and they could use it to grow their company. Now, here's the thing. There are a couple of things that you need to know when you're talking about bonds. Since bond is debt, there's a couple of things. Number one, if say you invest 1 million pesos in a bond and the interest rate is 4%, and that you need to know also how long is the tenure, how many years will you be paying the bond. So meaning if it's 7-year bond for 4% interest, it means for the next 7 years, the company who borrowed money will be paying you 4% for the next 7 years. That also means that regardless of what happens, as long as a company is earning, no, as long as a company does not go bankrupt, you can expect that you will get 4% for the money that you placed for the next 7 years. Now, here's the thing. As an investor, the biggest advantage of that is this. If you want cash flow, you want returns that are somehow higher still than time deposits, somehow higher still than other fixed sources of income, or somehow you get cash flow that's large and can beat inflation, bonds will do also the deal for you. So the technique here is this. The way you can strategize is, and the way you can start buying here is this. You buy it, then as long as the company's good, as long as you know they have the ability to pay it, you will have your cash flow. You will have your repetitive gains over a stretched period of time, and that's how you can segment it. You can treat it like a time deposit that you don't plan to touch. You can treat it like a time deposit that regardless of what happens next year, 2 years from now, 3 years from now, as long as the company has the ability to pay, you have nothing to worry about. So what's the risk here? One of the biggest risks is basically this. Number one, if the company closes down, of course, there's a big chance that either you don't recover your capital or you recover just a portion of it. You don't have any cash flow. What's another risk that you can peg to this? Another risk is basically, what if you start buying just common shares with dividends? If you buy common shares with dividends, the yield that you may get from it or preferred shares might be much higher than bonds. So if you are a person that wants specific gains, you are a person that wants cash flow, you are a person that's a little bit conservative, then bonds will do the trick for you. Now, let's give this scenario. Ayala Corp has bonds. Ayala Corp also has stocks. The bonds give you fixed interest rate. The stocks give you dividends. The biggest advantage though of stocks versus bonds is this. You buy Ayala Corp shares, it gives you dividends, but because the company is good, the company is growing, the company has a trajectory of doing well, what you can expect is this. 10 years down the line, the stock price might be higher. 10 years down the line, you might have capital appreciation. For bonds, if you hold it up until the 7-year maturity, you hold it up until the 10-year maturity, there's a chance that you just get the amount that you placed as well, assuming that they're able to pay everything, assuming nothing bad happens to it. So meaning if you place 100,000 pesos all the way to the end, you'll also get 100,000 pesos plus all of the interest that they gave you. For stocks, you hold it either preferred shares or common shares. For preferred shares, 100,000 till the end, you get your 100,000 back. But for common shares, there's a chance that, hey, at the end of the 10-year period, head to head, you might have a bit of capital appreciation, and that's your biggest advantage. The biggest advantage of investing in the stock market is you have capital appreciation plus you also have dividends. But of course, similar to what everyone has been talking about, the higher the risk, the higher the reward. There's a greater risk in the stock market because there could be years that they could not give you any dividends. There could be years that there's volatility in the stocks that you're looking at. For bonds, there's also volatility because they move via interest rates. But the movement of bonds is less volatile, it's less risky head to head up against the stock market. Now, so you know how you can get them. If you want to buy bonds, the easiest way for you to access bonds is via the bank. Every time there's an offering, my suggestion also, if you're going the route of bonds, is you go every time there's an offering, so at least you get them at the market price. You don't have to buy them at the premium because we don't know how interest rates will be as well. But if of course you get to buy them at a discount, then of course you can buy them even if it's not at the date of it being sold. But one of the best ways for you to do it is go to the bank, always befriend your bank manager, and it depends on what the offering price is. For some, there are retail treasury bonds, or there are retail bonds that could start at 5,000. There are some at 50,000. So it depends on what the offering size is. But the way and access you can have for it is via the bank. Unlike in the stock market, you can open and buy bonds via your stockbroker. The biggest difference of bonds and stocks is for you, it doesn't have a brokerage platform yet where you can check your portfolio online. You can buy and sell online. The way for you to buy and sell bonds is still via the bank. It's not as liquid. It's liquid in the sense that when you sell it, the bank is the one who will find someone who will sell it for you, but you'll have to find a match first, and they will have to sell it at the price also where the bank makes money, and dependent also on the specific interest rates on that period. So my suggestion is also this: if you want to earn via bonds, just put an amount of money that you don't plan to touch, that you want to get cash flow from it over a specific period of time. Ganon din naman sa stock market. Anything that you treat as an investment, you should have this notion that you don't plan to touch it over a period of time. Anytime you have an investment, anytime you put in money, just always forget about it. Think about it, it's gonna go to zero. And then, but if it doesn't, you get your cash flow. But if it doesn't, you get also capital appreciation. If you're a person who is relatively conservative, then bonds are the way to go for you. If you're a person who just wants cash flow and you want your money to be the same when the 10 years finish, go for bonds. But if you want capital appreciation up until the end, then go for the stock market. So if I would rank it, over here is cash accounts. You can add time deposits here. Then over here, I'll put bonds. By the way, there's two types of bonds. You have retail treasury bonds. You have treasury bonds. You have government bonds, and you also have corporate bonds. Between the two, government bonds are less risky because the likelihood of a government defaulting, meaning they won't be able to pay their debt, is lesser than a corporate bond where the company could also go bankrupt. But in terms of head-to-head, corporate bonds will give you a higher interest rate versus treasury bonds or versus government bonds. Then here's the thing also, a riskier company will give you a higher interest rate than a more stable company. So that's how you can segment it. If you want something that's more reputable, you want something that has a higher likelihood of safety, they will pay you a lower interest rate, while the one that has a higher risk attached to it will give you a higher rate of return. So savings accounts, treasury bonds, government bonds, corporate bonds, preferred shares, then common shares. So that's how you can segment it. One will give you interest rate. Government bonds and corporate bonds will also give you interest rates. Then you also have preferred shares, which will give you dividends that are relatively fixed. Especially if it's preferred shares, it will give you most of the time rates that are higher than what you get in bonds. Then lastly, common shares. Common shares can give you dividends. However, it may not be as high, but yung bawi nyo dun will be capital appreciation as well. So I hope you're learning off of this. My suggestion is this: you can just diversify again. If you're a person that you think you're more aggressive, then put more still on the stock market. If you're a person that, but then put a smaller amount into bonds, then flip it. If you're a person who's more conservative, put more into bonds, but flip it also. Put a small portion in the stock market. At least you're still diversified. At least you have a small amount of, you have exposure to everything, because that's the name of the game. The name of the game is to build as much assets as you can. The name of the game is to position yourself so that those assets will work hard for you. My challenge to all of you is this: don't be scared in trying. Don't be scared in putting a certain amount of money on those asset classes, because later on, as you gain the experience, the skill, and the acumen, those items will help you make money. And as you start to earn more, you get to double down and you get to put as much as you can on those asset classes as well. So if you have any questions off of this, comment them below. If you have anything that you want me to explain more, comment them below, and I'll try to make more videos off of that as well. So I guess that's it. I hope you guys learned a lot from this. I hope this is something that added so much content to all of you, and I hope that this gave you the rudiments on how you can trade the markets with ease and confidence as well, because that's all I want. And the reason why we just keep making videos like this, so that you get educated and you get to trade and you get to know what it is, and you get to pick specific areas and build as much assets as you can in the prime years of your life. So that's it for now. Marvin Germo. I'm still here in Seoul, South Korea. I hope this video helps you. Trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.